here we've got the calendar year returns of a 60-40 portfolio versus cash over the last 3 years. And for those that don't know what a 60-40 is, essentially it just means you've got 60% in growth assets versus 40% in income assets.
So really a version of a balanced portfolio.
Exactly, yeah. And so we've used that as a proxy because we thought that, would best highlight sort of your average investor. And you can see here that had you invested in 22, you probably would have started to ask yourself, why didn't I just keep my money in cash, right? And I'm sure you probably had this conversation with some of your clients as well. But over on the right there, you can see, over 3 years, we're pretty flat in terms of a 60-40 versus cash. So they've delivered this similar sort of results. However, if we zoom out of the short-term period, we can see, the true value of a 60-40 portfolio. Over on the right, when we do zoom out of this long-term period, and not just 3 years, over 22 years, a 60-40 portfolio has certainly delivered much more than that 3% on the previous slide, right? And we can see that there's obviously a positive skew to the right-hand side of the graph, and the returns are actually more in, or majority of returns, sorry, actually more in that 10 to 15% range there. And what this is showing is it's regardless of the negative years, there's always going to be the positive years as well. And what's even more interesting about this graph on the right here is that the really good years are often preceded by the really bad years. So you can see there the jump between 22 and 23, which is pretty interesting to see as well.
And it's also important to note just what a unique and unusual year 2022 was. So the Venn diagram on the left-hand side of the screen there shows for both global stocks and global bonds those years which had negative absolute returns. And of course, there's a few more years on the equity side than bonds, which is to be expected. But over the last 22 years, only 2022 was the solid year where both equities and bonds at the same time had a quite material negative return. So yeah, very unique in terms of the track record over recent years.
Look, even bigger picture, zooming out even more, you can see that regardless of what's going on in the world, since 1975 here, this chart is got geopolitical events. We even went through, COVID-19, a pandemic. Yet market resilience does. It stays resilient over the long term. It manages to mute the impact of all of these events. So just again reiterates the importance of staying invested over the long term there.
So Felicia, that's saying $1 invested in 1975 you'd have $153 today.
Yeah, that the median age is being pushed out. And we've got actually 1 in 5 women that are expected to live to 95 and beyond, which is quite extraordinary. So exactly same graph for males, it's just sort of pushed 2 years earlier.
So that really calls into question that whole philosophy that you turn 65 and you should be in a conservative portfolio because you've still got a very, very long investment time frame.
Absolutely.
So the way Russell structures the report is we have 4 main sections, A, B, C, D. Each of them address a different element or part of the advice process. So A is for active rebalancing of portfolios. B is for behavioral coaching. C is the customized experience that an advisor brings to the end client. And D is don't lose sight of real returns. So we go through and we allocate a percentage value to each of these sections. And we aggregate those values up. And at the very end, we came to the conclusion that the value of an advisor in New Zealand in 2023 was 5.9%.
And linking that back to clients' real life experience, right? We have people who retired in 2020 or 2022 that they would have experienced if their portfolio has drifted towards a growth allocation, they would have experienced significant drawdown in their portfolio. And we know how investor psychology work. I've actually spoken to a client who retired in 2022. They were planning to go, the world opened up, they could go overseas, but because their portfolio dropped back and they decided maybe I wouldn't do that overseas trip or I wouldn't buy that camp van. So therefore, having a bit of having the active rebalancing will ensure they achieve the goal, which is to have the lifestyle that you want to live.
So this is showing that where people get spooked, they sell at a bad time, and then the markets recover, they start to get FOMO, and then they jump in to
Exactly.
the market. Yeah.
Chasing returns.
Yes.
In essence. As soon as you're chasing, you're always going to be behind. The old saying, better to have time in the market than try and time the market. So being invested and staying invested will serve you better than trying chasing returns.
And while I can acknowledge there's certainly maybe some reasons why it might make sense to have an allocation to the New Zealand share market, it's important to remember that there are a world of opportunities out there. And in the New Zealand equity market in particular, we've got a really high concentration and reliance on just a really small number of companies. So being exposed to that subset, can be really great when things are going well, but a little more challenging when they're not. So
yes. We felt this could be D for diversification.
Absolutely, yeah.
But yes, even Australia, which is significantly bigger than New Zealand, doesn't get a wedge on that right-hand graph. So New Zealand is tiny.
It really is, yeah. You don't want to limit yourself to sort of less than 1% of the investable universe.
And miss out on NVIDIA and Microsoft.
Exactly.
An example that I remember vividly is in a couple of years ago, I was talking to a couple in their 40s, and we have a plan for them to put in the regular contribution. And when I turned up for the annual review, I was getting a lot of questions from them about the portfolio performance versus the market indices, while in the meantime, they're actually not putting any contribution at all. So the question that I have for them is, all this extra time that you put into getting an extra 1%, 2% return versus the contribution that you put in on a regular basis over the next 15 years, what is going to make the bigger impact? The answer is obviously the later, right? So I think as a financial advisor, what's really important is helping people focusing on asking the right question, focusing on the right thing.
And preservation of their capital, clearly through retirement, that becomes very important. Some people are happy to spend just the income from their portfolio. Others will happily run down their capital as well, and the kids get the house. And I find quite often I'm encouraging people to spend their money because otherwise the kids will go business class. But yeah, that's all about what is a safe withdrawal rate. And one strategy we often use is to have your next few years spending in a very low volatile fund or cash, so you can take more risk with your bigger portfolio.
Yeah. And one thing I want to add is, as people go through accumulation phase and move into the decumulation phase, that can be quite scary, because you are used to building up your bank balance. Now you are drawing it down, right? So going back to Jean's point about calculating what's a safe withdrawal rate and running these numbers. And I think sometimes people like to bury their head in the sand, but knowing your number is actually liberating, because then you draw a line in the sand, you know where you stand, whether you should put in more or delay your retirement for a few years, how much you can afford to spend each year, and you get permission to spend that money. That's equivalent to a better retirement.
Just make sure that investors are always thinking that even though right now at the banks, there are higher than over recent years, higher term deposit rates on offer. After you take into consideration inflation, maybe they don't look as great as the headline suggests.
Yeah, and of course, everyone is looking at the past 3 years and saying, well, I could have earned 6% on term deposit, but that's another example of recency bias, because you roll back to 2020 and 2021, you'd be lucky to get, 1.5 maybe? The feeling was that, if anything, the value of planning, so taking someone, as Joyce said, in their 50s and telling if they can start saving $1,000, $2,000 a month, perhaps they pay their mortgage off early over 15 years, that could be worth $200,000, $300,000 for their retirement spending. And I think that's just knowing your end target, you're much more likely to achieve that. And nobody ever got to 65 and thought, gosh, I wish I didn't have that extra money.
Yeah, and I also want to make a mention on the behavioral coaching. I think this sometimes comes with a negative connotation, and client might feel like, I don't need you to coach my behavior. I think at the end of the day, it is the ordinary predicament of being human. We are all exposed to fear and greed, and we are emotional. And the value of having a financial advisor is there is a discipline, and also you're really having a sounding board and somebody holding your hands throughout that journey to give you the right recommendation and help you get to the neutral state where you are empowered to make better financial decisions for yourself.